Friends, today we will learn about Accounting Standard 22. This deals with accounting for taxes on income. So, we will have income tax, and in income tax there are some components like current tax, deferred tax. We will learn all these interesting words today. So, it's going to be a very interesting standard that we are starting today. This standard is based on a few words which you would have already heard of. Prudence, matching concept, accrual. Did we hear of these words in the past? Definitely, right? At CPT level itself, we would have heard of these words. So, you will realize that in accounting standards, all these big standards are all based on simple words, simple concepts like matching concept, matching between the incomes and expenses in a specific period, right? Then you talk about accrual, where you account for something when something accrues to you, not when you actually receive or pay. So these kind of concepts, what we would have learned at CPT level, we will use them and learn how the standard on accounting for taxes on income works. Now, what is matching? Incomes and expenses should be matched in a specific period, meaning if you are recording income of a specific period, expenses for that period also should be recorded in the same period, right? So you have to have in a P&L account incomes and expenses of a period captured at once, right? So that is what you mean by matching concept, right? Let us take a small example on income taxes. Imagine there is a company which is subject to taxation, meaning that company has to pay income tax. Okay, fine. Now, there are two columns. First column is for Companies Act based calculation, or we can call it as accounting standards based calculation. So this is for accounting purpose, right? This second column is for income tax purpose, right? So we have one column for accounting purpose and another column for income tax purpose. Now, sales of this company, say 10 crores. Then expenses, direct costs of this company, say 6 crores. So 10 minus 6, 4 crores. Then depreciation as per Companies Act for this company, say 2 crores. So 10 minus 6 minus 2. So what is the profit right now? 2 crores is the profit. Okay, great. 2 crores is what we have as profit here. Now on this profit, say if you apply tax rate of 25%, if tax rate be 25%, apply 25% on that. So 2 crores into 25%. So what will the taxation be? Tax will be about 50 lakhs, right? So this is the story what you see as per accounting. Now listen carefully, friends. There are a few terminologies what we have to learn from this. There is something called as profit of 2 crores. That profit of 2 crores is based on accounting calculations. That profit is called as accounting profit. Okay, so we call it as accounting income in our accounting standard. So it is an accounting calculation based profit. We call it as accounting income as per this accounting standard. Now, based on that, you made a tax calculation, right? That tax calculation 50 lakhs what you got, we will call that as tax expense. We will call that as tax expense. So 2 crores we called as accounting income and 50 lakhs is the tax expense, right? Fantastic. Now, how does the income tax calculation work? Profit before tax what we had here is 2 crores. As we all know, in income tax, this 2 crores is the logical beginning point. So this 2 crores, profit before tax, 2 crores, that's the logical beginning point for income tax calculation. So imagine, so this is 2 crores, profit before tax. Then what do? Depreciation, whatever we considered as per accounting purposes, this we add back and we will subtract depreciation as per income tax norms, because income tax depreciation rates, income tax depreciation calculations are all different compared to the calculations what we make for accounting purpose. So 2 crores is the profit before tax, we add back the depreciation which we applied for accounting. So 2 crores plus 2 crores, we added back 2 crores minus depreciation as per tax purpose. Say it is 3 crores. Okay. So if it is 3 crores, then what will happen? 2 plus 2 minus 3. What will the profit for tax purpose be? 1 crore. This profit is called as taxable income. On this taxable income, we will apply tax rate. Now, if we apply 1 crore into 25%, 25 lakhs, that 25 lakhs will be called as current tax. Alright? Here we learned 4 important aspects. What are those? Accounting income. What is accounting income? In our calculation we had 2 crores, right? That 2 crores is the accounting income. Then we had something called as tax expense, which is 50 lakhs in our example, right? So that is called as tax expense. Then we learned something called as taxable income. This is income calculated as per income tax norms. And fourth one is current tax. Current tax is how much in this example? 1 crore into 25%, 25 lakhs is the current tax. So let's first look at those definitions what we spoke about just now. Accounting income. It is the net profit or loss for a period as reported in the statement of P&L before deducting income tax expense. So generally we call this as profit before tax. We are calling it profit before tax. Sometimes it might even be loss before tax. Next, tax expense. Tax expense as per books of account is the aggregate of current tax plus deferred tax charged or credited to the statement of profit and loss for the period. Well, this sounds like a big definition. To keep it in simple terms, tax expense is equal to current tax plus deferred tax. What is deferred tax? We will discuss that in some time from now. Taxable income. The amount of income for a period determined in accordance with tax laws based upon which income tax payable is determined. So basically the tax based calculation, so tax act based calculation, we call it IT Act, right? So as per Income Tax Act, whatever we calculate as income, we call that as taxable income. Next, current tax. It is the amount of income tax determined to be payable in respect of taxable income for a period as per income tax laws, or tax computed on taxable income which is payable in the period. We spoke about taxable income. On taxable income, if you apply tax rate, we arrive at something called as current tax. Friends, in whatever we discussed till now, there is one important observation I want everyone to focus on. Depreciation is the point which changed the calculation between accounting and taxation, right? So as per accounting norms, depreciation was 2 crores. As per taxation, depreciation was 3 crores. Now imagine in the current year, depreciation as per Companies Act or accounting norms is 2 and that as per income tax is 3. In the next year, depreciation as per Companies Act or accounting standards is 3 and that as per income tax is 2. So finally, what does it mean? Even though there is a difference of 1 crore between the two which you see in the first year, by the time you come to the end of second year, there is no difference. Means the difference which got created in the first year is getting reversed in the second year. Because finally, if the asset is around 5 crores, that 5 crores of worth has to be written off. And the way it is being written off as per Companies Act and the way it is being written off as per income tax can be different. So the point is, when this write-off of that asset is happening in different values in between companies act and income tax, the difference which is getting created in one period is actually getting reversed in the next period or in the period after that. That reversible difference is what is called as timing difference. In other words, timing difference originates or starts in one period, but the difference will automatically get adjusted in the subsequent accounting periods. If it gets adjusted, we call it as timing difference. If it doesn't get adjusted ever, we call that as permanent difference. So friends, is depreciation a timing difference or permanent difference? Timing difference, because difference is getting created in year 1 and getting reversed in year 2. So as a result, if you look at the tax implication, imagine the statement what we saw for accounting and taxation a little while ago, imagine the same statement you want to make for next year. Next year, if, okay, so we have the column for accounting income, so sales is same, expenses are same, depreciation as per accounting say is 3 crores, and now change the one as per income tax to 2 crores. What has happened? Do you find a change in the taxation? In year 1, we had 50 lakhs as tax expense and 25 lakhs as current tax. But in year 2, what has happened? Exact opposite. In year 2, tax expense is 25 and current tax is 50. So you actually find that the situation has reversed. Friends, accounting standard says in current year, that is year 1, we had calculated that 50 lakhs is our tax expense, but current tax is only 25. It means even though 50 lakhs of tax expense has accrued to the company, means company is liable to pay that, only 25 lakhs was due in first year. The balance, it's not that it is not due, the balance actually fell due in the second year. So basically 50 lakhs of tax expense, is it finally being paid at some point of time or not? Yes, it is being paid at some point of time. Out of 50 lakhs which is recognized as an expense in the first year, 25 lakhs is paid in first year, 25 lakhs is paid later. We deferred it, we postponed it. And when you come to second year, in second year what is happening? In second year, 25 lakhs is only the tax expense. So technically we should have paid only 25 lakhs as current tax. But how much is being paid? 50 lakhs as the current tax. So in 50 lakhs what is paid in the second year, 25 lakhs is the expense of second year paid in second year. But 25 lakhs extra is the expense of first year paid in the second year. So what do you see here? There is a difference between the time when you are accruing the expense and when you are actually paying for it. This difference has to be recognized in the books of account. That gives rise to a concept called as deferred tax. So what is deferred tax all about? Defer, it is a word in English, right? So defer generally refers to postpone. You have to study today, I just deferred it. So what does it mean? I postponed it. Something I should have done today, I postponed it. In general language, when we say defer, it is just postpone. But in the context of accounting standard, the word defer is not just postpone, it also includes advanced. So the crux of accounting standard 22 is this: sometimes you save tax now, like in the case of first year, but you will pay later, right? Save now, pay later. Sometimes you pay now and save later. So this timing difference is what has to get recognized in the books of account. That is what deferred tax is going to be all about. Now imagine there is something like a penalty of 1 crore that is paid by the company. Now in the books of account, that penalty would have been debited under miscellaneous expenses or some category like that. So 1 crore got debited to P&L account of the company, right? So this 1 crore got reduced to arrive at PBT, correct or not? So when 1 crore is debited to P&L, that 1 crore is reduced to arrive at that profit before tax number. Now come to income tax. What does section 37 tell us? Penalties are not admissible expenses. So under that category of general deductions, we clearly have those items which are not deductible. Under that we have these penalties. So penalty cannot be considered as an item of general deduction. So what will happen as a consequence of that? This 1 crore is debited to P&L, it reduced PBT, but it is not reduced to arrive at taxable income. Means in PBT, if it was deducted, you will add back the amount of penalties, right? So when you add back the amount of penalties, the total amount before deducting penalties is what we are considering as taxable income, and actually tax is paid on taxable income. So look at the challenge, friends. There is an item which is deducted for accounting purpose, which is not allowed for tax purpose. Is it not allowed for tax purpose only in the current year or even in the future years? It will never be allowed for tax purpose. Whether it is in the current year or in the future years, it will never be allowed. Acha, this is giving rise to a permanent difference between the accounting calculations and tax calculations. In accounting, you may debit, but for tax, you cannot. So you have to pay tax even on the amount on which you paid penalty. So friends, as a result, there is a permanent difference which is getting created. On permanent differences, there is no deferred tax. Why? It is not that you save now, pay later, or pay now, save later. No, it's not like that. It is a structural difference between accounting and taxation. So such items are called as permanent differences on which you don't create deferred tax. Let's take another example. Research of scientific nature. We call it as scientific research, statistical research, etc., which we have in our income tax. Now, on an amount of 100 rupees say spent towards research, as per accounting norms, what do? You debit 100 rupees to P&L. If it is a research which is to be debited to P&L, you debit entire 100 rupees to P&L. But what does income tax tell you? As per income tax, for every 100 rupees of expenditure, you get something called as weighted deduction. So you will deduct for income tax purpose not 100, much more than that, 125 or even more than that, you will deduct for that income tax purpose. So 100 rupees is debited under accounting, but maybe 125 is debited under tax norms. This extra 25, will it ever get reversed? No, it will not get reversed. So it is a permanent difference which is getting created. Friends, on permanent differences, there will not be deferred tax, that's all. Now, as a definition, current tax plus deferred tax is equal to tax expense. Now, current tax plus deferred tax, what is this deferred tax? Mathematically, if you look at it, tax expense minus current tax should be deferred tax. So basically, it is a difference between tax expense and current tax. What is tax expense? Accrual concept based tax calculation. What is current tax? Income tax rules and laws based tax calculation. So this difference is what gets captured into the deferred tax concept. Okay, now we will take a small example to understand this in detail. Friends, in the example that we discussed towards the start of the session, profit before tax was at 2 crores and taxable income was at 1 crore. 2 crores, 1 crore. What is the difference? 1 crore. This 1 crore, now we will call it as difference. We are not saying timing or permanent. It could be timing difference or permanent difference. So difference is 1 crore. Okay. Second question. What is the reason for a difference like this to get created? Depreciation for this purpose was 2 crores and for tax purpose was 3 crores. That was the reason for this difference to have been created. Acha. So reason for that 1 crore difference is depreciation. Okay. Now ask yourself, is this depreciation a timing difference or permanent difference? We understood that concept already. This is timing difference. So we concluded that this 1 crore is timing difference. On timing difference, apply tax rate. What is the tax rate? Say 25% is the tax rate. If you apply 25% of tax rate, 1 crore into 25%, 25 lakhs. So what is deferred tax? 25 lakhs is the deferred tax. Now let us put all these things in the equation that we were talking about. Current tax plus deferred tax is equal to tax expense. Current tax in our calculation was 25. Deferred tax we just made a calculation, that is also 25. 25 plus 25 is equal to 50. What was the tax expense in our calculation earlier? 50, right? So 25 plus 25 is equal to 50. Some of us now must be thinking, sir, why did you do so much of hard work to arrive at deferred tax? We would have just done it in no time when we had 50 under tax expense, when we had 25 under current tax. Hurry, just take the difference between the two. No, so 50 minus 25, 25 is the deferred tax. Is it that straightforward? No, don't do that mistake ever. Friends, recall, why will deferred tax ever get created? Because of timing difference. So if there was a permanent difference, then automatically you will not say 50 minus 25, 25 lakhs is the deferred tax. No, you wouldn't have said that, right? This 25 lakhs is the deferred tax only because the difference is timing difference. Friends, that is why let us avoid all these stupid shortcuts. Let us go back to the principle. What is the principle? Check the difference between PBT and taxable income. That is the first step. After that, if there is no difference, the discussion ends there. If there is difference, see whether the difference is timing difference or permanent difference. If it is permanent difference, ignore. There is no deferred tax that you need to create on permanent difference. If it is timing difference, in our example, it was timing difference. On that, apply tax rate. When you apply tax rate on that, that amount what you get is what you are calling as deferred tax. Now comes the question, which tax rate should you apply on this timing difference? Friends, for current tax, you use the tax rate for current accounting period, right? For current tax, you use the tax rate for current accounting period. This deferred tax is getting created on timing difference. This timing difference originates in one period. It is capable of reversal in the future accounting periods. So it is created now, but it will be reversed in the future. When it is getting reversed in the future, the tax rate what we should use is not the current tax rate. The tax rate what we should use is the future tax rate. Hurry, how will we know future tax rate today? For that, we have in the accounting standard a concept called as substantively enacted tax rate. What is the meaning of substantively enacted tax rate? Friends, the budget is out. We know the tax rate for next year. Today, we already have the tax rate for next year. Take the tax rate. That tax rate you will apply on this timing difference. Imagine if that tax rate were 30%, you would have applied 1 crore into 30%, not 1 crore into 25%. So you will not apply the current year tax rate for the timing difference. You will apply the future tax rate. That future tax rate, once again, what did we call that future tax rate as? Future tax rate is called as substantively enacted tax rate. That tax rate you apply, that amount what you get is what is called as deferred tax. This deferred tax can be a deferred tax liability or a deferred tax asset. Well, what do these two words mean? We'll understand with the help of an example. Friends, in the instant case that we discussed just now, what happened? Depreciation as per accounting norms was 2 crores, but depreciation which was deductible for tax purpose was 3 crores. Here 2 crores, here 3 crores. As a result, what happened? This extra 1 crore which got reduced for tax purpose resulted in taxable income being lesser than profit before tax by 1 crore. Correct or not? Now, this extra 1 crore which got reduced also had an impact on the current tax, right? So current tax was only 25, but when you looked at the tax expense, that was 50 lakhs. Friends, this difference which got created, even though as per accounting norms we are saying 50 is the tax, 25 is only the tax what income tax norms ask us to pay. Is it that income tax norms are asking us to pay 25 lakhs and is it a permanent benefit of 25 lakhs? No, it is not a permanent benefit of 25 lakhs. Benefit today, burden tomorrow, right? After all, the concept of deferred tax was only like this: save now, pay later, pay now, save later. Means burden now, benefit later, benefit now, burden later. So it is just a concept of there is no real benefit forever or real burden forever. It is just that there is benefit in one period, burden which is getting offset in the next period. So that sort of a mechanism you notice. In such a case, even though 25 is only the current tax which you have to pay, you know that extra 25 is payable, right? So extra 25 is payable in the future. It is payable in the future. But when is it originating? It is originating now. It is originating now and payable in the future. It is something like this: rent, expense. It is originating in this period. You have to pay in the, say, next year or year after that. So when I say deferred tax also, it is not just reversed in the next year. Next or any future years, it can be reversed. So rent expense you will account. If it is something payable in the future, what is the journal entry you would pass? Rent expense account debited to rent payable account. Rent payable is a liability, right? So very same way, when it comes to deferred taxation, what is the journal entry that we might write? Deferred tax expense account debited to deferred tax liability account. Deferred tax expense account debited to deferred tax liability account. This deferred tax expense in turn will get transferred to P&L. The entry for that will be profit and loss account debited to deferred tax expense account. So it will get charged off to profit and loss account of this period. So into P&L, how much will go? 25 plus 25, 50 will go and get debited to P&L. And how much is the liability? Liability is at 25. What happened to the balance 25? Balance 25 ideally would have been paid off. If it is paid off, fine. If it is not paid off, even that will still be carried as a tax payable. So friends, the crux of the story is this. Here the transaction gave rise to a deferred tax liability which got created in this period, which is capable of reversal in one or more future accounting periods. Let's talk about deferred tax asset. When will this get created? Imagine in the very first year, depreciation as per accounting, say it's not 2 crores, it is 3 crores, and depreciation as per Income Tax Act, say it is 2 crores. Imagine, everything else is same, just that depreciation as per accounting is 3 crores and depreciation as per income tax is 2 crores. Earlier it was 2 and 3. Now we are making this 3 and 2. Okay, right. In a case like that, what will happen? The profit as per accounting will be lower, but the profit as per income tax will be more. If the profit as per income tax is more, what will happen? On more amount you have to pay tax. Achha. On more amount you pay tax. On more amount if you pay tax now, is it that permanently this is a burden on you? No. In the future, it will be reversed. What may happen? In the next year or year after that, sometime in the future, it will be 2 and 3 again, right? In the first year, 3 and 2. Sometime in the future, it might be 2 and 3. So situation may reverse in the future. So when situation reverses in the future, this extra burden what this company experienced in this year, it will be benefited in that period. Company suffered extra burden in the current year. That's right. What do you mean by extra burden? Company paid tax on more amount. Achha. Company paid more tax. Okay. It paid more tax. This more tax what it paid has a portion in it which is for future. So it is something comparable to tax paid in advance, tax paid ahead of time. So don't call it advance tax. I'm just giving an example. It is tax paid ahead of the time. So maybe it was payable in future, but it is paid off right now because Income Tax Act is asking you to pay now. This amount what you paid now, is it something like prepaid? This is prepaid. Prepaid expenditure is not to be treated as an expenditure, it should be treated as an asset. Prepaid expenditure should be treated as an asset. So here the current tax is 50 and tax expense is 25, right? Now imagine there is a profit and loss account. Tax expense of 25 should be the net impact which should hit the profit and loss account. That is the accrued portion. So net impact in P&L on account of this should be 25 lakhs. But how will that be achieved? Listen carefully. Current tax is 50, right? That current tax of 50 first debited to P&L, okay, right? Current tax of 50 is debited to P&L now. Next, net impact what should be debited is only 25 lakhs, but 50 lakhs is already debited to P&L. Then what do? Reduce 25 lakhs from that. Reduce 25 lakhs from that. So reducing 25 lakhs from that or mathematically crediting to P&L give the same effect, right? So reduce 25 lakhs from that, calling it as deferred tax asset. So deferred tax asset is technically or mathematically credited to P&L and deferred tax liability would have been debited to P&L, okay, right? So when 50 is debited, 25 is credited, what is the net impact that you achieve? 25 is the net impact what you achieve in the process. So that 25 is the tax expense what is going in. So friends, this extra 25 what we are paying in the form of current tax, we will now call that as deferred tax asset. That's all. So we got clarity on the concept of deferred tax liability, deferred tax asset. Quickly draw two P&Ls to compare what has happened in deferred tax liability situation and deferred tax asset situation. In deferred tax liability situation, what we already discussed, in P&L, first 25 got debited as current tax. Here how much got debited as current tax? 50 got debited as current tax in this situation, right? Next, after that, in the deferred tax liability situation, what is the further amount which got debited, not credited? Further amount got debited as deferred tax liability. How much was that? That was extra 25. So that the total which got debited to P&L was 50. But in case of deferred tax asset, 50 of current tax was debited, then 25 of deferred tax asset was credited and the net impact that hit P&L is only 25. So finally, what will hit the P&L? What is going to get transferred to P&L? Current tax net of deferred tax adjustment or current tax along with deferred tax adjustment will hit P&L. When I say deferred tax adjustment, it can be adding this deferred tax to current tax if it is deferred tax liability or reducing deferred tax from current tax if it is deferred tax asset. So friends, in this deferred tax liability case, what has happened? Save now because we paid only 25, pay later, right? Save now, pay later. In deferred tax asset case, what happened? Even though our expense was 25, we paid 50. So we paid now to save later. Now, a small question can come in our minds. If we pay more money now, when we say we'll save that later, This money, had we not paid, we would have earned some interest on that, right? Don't worry, these points are not relevant for the accounting standard, because accounting standard simply says time value of money, means interest factor on all these aspects should be ignored. Why? You are paying or not paying because of Income Tax Act. So whether you lose money or whether you earn money, all those things because of paying early or paying late, those things are not to be considered, because Income Tax Act has asked you to pay, you pay that. That's all. So considering that, ignore time value of money. We call this present value concept and all. Ignore those concepts when you are dealing with deferred tax. So friends, if income is earned in this period, on that, if the tax as per accounting norms, means tax expense, is 50, even though the tax that is paid now is only 25, you are still accounting for the balance 25 also, if it is on account of timing difference. Means what are you doing? On that income, whatever is the tax that is attributable, you are accounting for it in this period only. Matching concept, that's all. Now, let's go into the depth of deferred tax asset. There are some special points regarding that. Deferred tax asset, first of all, it is an asset, right? When I say it is an asset, recall the meaning of asset. An asset is a resource owned or controlled by the enterprise. Okay. On that resource, there should be a potential to get future economic benefits. Remember, whenever we say something is an asset, there should be a potential to get future economic benefits. When you buy a mobile, if that mobile is expected to have a life of 2 years, you are expecting benefit over 2 years time, so you can call it an asset, right? On the other hand, if you just fill petrol into your bike, that bike petrol may just run for maybe 5 kilometers, 10 kilometers, 50 kilometers, whatever the distance be. Can you call that an asset? Whatever you fill into the bike as a petrol, can you actually call that as an asset? Listen friends, it is an asset till you use it. If you don't use that petrol, it is still an asset, because it has the capability to generate economic benefits for you. It is still an asset. But if you have used it, that becomes an expenditure, right? Now, listen carefully. An asset is a resource which has the capability to generate future economic benefits. If I want to call something as a deferred tax asset, this deferred tax asset also should have the capability to generate future economic benefits. That yes or no? Because it is an asset. So by the definition of an asset, deferred tax asset also should have the capability to generate future economic benefits. Fantastic. How do you get future economic benefits? How will this deferred tax really give you benefit? Let us recall one sentence that we discussed. Pay now, save later. We said this. You are paying now, but you will save later. Acha, what is that saving in the future we are talking about? You may have taxable income, on that you may have to pay tax in the future. Even though you may have to pay tax in the future, you will save that because you already paid now. I am repeating, very simple to understand. Listen carefully. You paid now. You will save later. That is what we said. Or in deferred tax liability, what did we say? Save now, pay later. So in the deferred tax asset, what did we say? Pay now, save later. So you paid now, you will save later. When will you save later? Saving will come in the future when you have taxable income. You have to pay tax on it. You will not pay tax on it because you already paid now, right? This means in future we are talking about there being taxable income. Just imagine, if there is no taxable income in future, is this really called saving then? No, it's not really called saving, because you paid now to save later. If there is no income, where is the tax, right? If there is no income, there is no tax. If there is no income and if there is no tax, where is the question of saving coming up? So friends, for deferred tax asset to give us benefit in the future, there should be taxable income in the future. Is everybody clear about that or not? Now, if there should be taxable income in the future, accounting standard says, how sure are you that there will be taxable income in the future? How sure are you that there will be taxable income in the future? The company says, hey, we are very sure there will be taxable income in the future. Accounting standard says, prudence, prudence, be careful. What is the meaning of prudence? If there is an anticipated expense or loss, provide for it. Provide for it means what? Debit to P&L, provide for it right now. If there is an anticipated gain, ignore it. If there is an anticipated gain, ignore it. In the future, you may or may not get a gain. Ignore it. Prudence is what we are going to use here in actually talking about deferred tax asset. How? Listen carefully. The company has a deferred tax asset situation. The accounting standard says, I will not allow deferred tax asset to be created automatically. Acha, why? We will not allow that to be created automatically because for it to meet the definition of an asset, there should be some comfort that in future we will have taxable income. What is so big deal about it? Imagine the company is suffering losses now, and in future we are saying we will have taxable income. If the company is suffering losses now, or if it has any unabsorbed depreciation, means the depreciation fully is the profit available is not sufficient to fully absorb the depreciation. In a case like that, the company says, in future I will have profit. The question is, how will you have profit? Demonstrate, prove to me as to how you will have profit. So the accounting standard says, if the company presently has any losses or unabsorbed depreciation, there should be virtual certainty supported by convincing evidence. Listen to the words, virtual certainty supported by convincing evidence that there will be future taxable incomes that the company can earn against which this deferred tax asset can be set off. Unless there is virtual certainty supported by convincing evidence, you do not create a deferred tax asset today. I will repeat this point. Listen carefully. It's very, very important. What are we talking about? The company has deferred tax asset situation. Accounting standard does not automatically allow you to create a deferred tax asset. Accounting standard says, check whether the company has any current year losses or unabsorbed depreciation. If the answer is yes, then only if the company has virtual certainty supported by convincing evidence that in future there will be profits, don't recognize deferred tax asset today. Acha. Virtual certainty. Do you understand that word? Virtual certainty means what? Literally standing here, I am able to see. When I look into future, I am able to see. And there is definitely a chance of making profit. Because this contract is there, this is a committed cash flow, we are going to get this money, we will make profits in the future, those profits will be taxable. Like that there should be virtual certainty, almost 100%. When I just say virtual certainty, get the expression right. Almost 100% certainty that there will be profits in the future against which this tax what we paid now can be set off. Unless there is something so convincing, the company should not recognize deferred tax asset in a situation where current year we have accumulated losses or unabsorbed depreciation. On the other hand, if the company is already profit making right now, in such a case, well, if somebody is making money today, assuming that such person will make money in the future also is reasonable, right? On the other hand, if somebody is not making money today, we need more evidence to prove that that person will make money in the future. Same logic we are applying here. If the company is already making money now, if the company is already making profits now, then if there is reasonable certainty that the company will continue to make profits, that will be sufficient. That's all. So for a person who is not making money today, you need lot of evidence to prove that there will be profit in the future. But for a person who is making money today, you don't need so much of evidence. reasonable amount of evidence is sufficient to say that that person will continue to make this money in the future. So friends, in a case other than the losses or accumulated depreciation, there should be reasonable evidence regarding future taxable incomes on which this deferred tax asset can be set off. Friends, we discussed about deferred tax in general. Now remember, deferred tax is an accounting estimate. What do you mean by an accounting estimate? An accounting estimate is a close approximation of an account balance. It is a close approximation of an account balance. Why approximation? In the absence of precise means of measurement. You don't know how to calculate that exactly, but some approximation tools you are using. The meaning also includes using best available information at a given point of time. What is this last point? Using best available information at a given point of time. By this we mean, at this point of time, what all evidence you have, collect that, gather that, and arrive at the best possible estimation. So the accounting estimate has this kind of a meaning: closest approximation of an account balance in the absence of precise means of measurement, in the light of best available information at a given point of time. Right. I want to now emphasize on the last phrase, at a given point of time. What does that mean? At a given point of time refers to the timeliness of accounting estimate, meaning when you make the accounting estimate based on the best available evidence, at that point of time, such estimation changes from time to time. Let's take a simple example. You are at the start of a cricket tournament. You want to make a guess as to which team is likely to win. You will take the past data and you will take your experience into consideration and you will form your judgment. Now, the tournament is over. At the end of the tournament, you are asked to make your assessment as to who will win the next tournament. Now, is there a likelihood that your answer may change? Yes. At the start of tournament, based on the evidence what you had at that point in time, you made your judgment. At the end of the tournament, when you are asked to make judgment regarding the next tournament, you will make your judgment based on the data which you got from this tournament also. The same way, from time to time, accounting estimates change. Deferred tax being an accounting estimate, from time to time, deferred tax calculation also will be subject to changes. That is why at the end of every accounting period, listen carefully, I am not saying accounting year, I am saying accounting period. So if it is 3 months closing or 6 months closing, based on that, or if it is 1 year closing, based on that, at the end of every accounting period, deferred tax has to be reassessed or recomputed. Well, just remember this point. When we apply this into problems, you will understand in detail what this reassessment or recomputation means. Even deferred tax asset which was not recognized in the past accounting years can be recognized in the future accounting years when those circumstances regarding virtual certainty or reasonable certainty emerge in the future years. So the accounting standard says reassessment of unrecognized deferred tax asset has to be done at each balance sheet date. After all, deferred tax treatment is an accounting estimate. Previously unrecognized deferred tax assets can be recognized to the extent they became reasonably certain or virtually certain, as the case may be. Maybe in the past there was no reasonable certainty or virtual certainty, but now such reasonable certainty or virtual certainty regarding future taxable income came out. Then you can recognize such deferred tax assets. And then review of deferred tax asset at each balance sheet date. the carrying amount should be written down to the extent that it is no longer reasonably certain or virtually certain that future taxable income will be available against the deferred tax asset. Meaning, maybe last year there was reasonable or virtual certainty. Now that reasonable or virtual certainty is gone, then what to do? Write off that deferred tax asset what was recognized. So writing off means charge off to P&L. All these points you will see once again in detail when we actually start solving problems. Then they will become crystal clear to you. We also spoke about the tax rates. Let's quickly see the summary of that. Current tax, we should use applicable tax rates of current accounting period. Deferred tax asset or deferred tax liability, at what tax rate? At substantively enacted tax rates. Enacted or substantively enacted tax rates by balance sheet date. When I say substantively enacted, it is just that it may be there are some technical formalities pending, like if there is budget, unless the president signs the budget, you cannot say that budget is final and approved. So even though signature of president is pending, that budget rate can be considered because we don't have any history in the country of president of a country changing any tax rate. So going with substance over legal form, you can take the tax rate which is declared in the budget. So that is enacted or substantively enacted tax rate. And we also spoke about this point. Deferred tax assets and deferred tax liabilities should not be discounted to their present value. Interest factor should be ignored. So these are the points which we are quickly revising. Now let's talk about a few points on presentation and disclosure. If there is a company which has deferred tax asset, it also has deferred tax liability, can it set off this deferred tax asset and deferred tax liability? The standard says yes, subject to two conditions. What are the two conditions? Entity should have the intention to set off deferred tax asset and deferred tax liability. Second, it should be legally permissible to set off deferred tax asset and deferred tax liability. So intention should be there and it should be legally permitted. So if both those conditions are met, entity can set off deferred tax asset and deferred tax liability. So there is something appearing on asset side, something appearing on liability side, net them off and show it as deferred tax asset net or deferred tax liability net. This is 100, this is 50. Net them off, show it as deferred tax asset net, something like that. Then what about current tax? There can be current tax asset, something like advance tax paid, that can be current tax asset. Then there may be something like provision for tax, that is called as a current tax liability. Same logic. Can we set them off? Yes, provided entity has an intention to set them off and provided it is legally permissible to set them off. Now comes a question, hey, what is this legal permissibility? Friends, we cannot set off Indian deferred tax asset against US deferred tax liability. Oh, what is all this? Stop, listen. Maybe the company is operating in India and it is also operating in the US. In Indian operations, you may have deferred tax asset or liability. In US operations, if I see separately, based on US tax laws, there may be deferred tax asset or liability. You cannot net off deferred tax asset of Indian laws with deferred tax liability as per US laws or vice versa. That kind of a set off is not permissible. In other words, based on each tax jurisdiction, India is a tax jurisdiction. For India, maintain separate records, separate entries, everything separately for deferred tax asset and deferred tax liability. US is a separate tax jurisdiction. Again, for that, maintain separate entries, separate records, deferred tax asset, deferred tax liability calculations. These cannot be set off. Look at this illustration. Financial year is ending every year on 31st March. On 1/4/2016, the company purchased a machinery. The value of that machinery is 1,50,000. Useful life means the period over which this asset is to be written off is 3 years. Expected salvage or scrap value is 0. So at the end of 3 years, the worth will be 0 for that machine. Income tax depreciation is 100% in the very first year. So listen carefully. So this is only income tax rate, but as per Companies Act, we are going to write this asset over 3 years. Next. Depreciation method is SLM, straight line basis. Profit before depreciation and tax each year, say, is rupees 2 lakhs. Corporate tax rate being 40%. Let us see how deferred tax gets computed in this regard. Alright friends, now you just look at the question. So what do you see here? There is a company which has purchased machinery. What is the value of machinery that you get to see? 1,50,000. This 1,50,000 value of machinery should be written off. That is very clear. What is the salvage value? 0. So entire 1,50,000 has to be written off. Now, for the purpose of Companies Act, in how many years will you write that asset off? You will write that off over 3 years. So the asset is expected to have a life of 3 years. You see this right? Then you have, as per Income Tax Act, this asset being written off at 100%. Now pay attention friends. If the asset is written off fully in the first year as per income tax, assume that the asset is purchased before more than 180 days before the end of the financial year, and 100% of depreciation is applied on that asset, and the asset is written off fully in the first year. What will happen? Plot a timeline and check out. As per Companies Act, plot year 1, year 2, year 3. Year 1, SLM method, right? 50,000, 50,000, 50,000. Year 1, 2, 3, 50,000, 50,000, 50,000. As per income tax, again draw another timeline, check out what is happening. As per income tax, in the very first year, entire 1,50,000 is the depreciation. Now, what is happening because of this kind of completely writing off the asset in the very first year for income tax purpose? In the first year, if you compare 50,000 and 1,50,000, in income tax we have written off extra 1 lakh, right? Okay. Now come to second year. In second year, what is happening? 50,000 you are writing off for the purpose of Companies Act, but you are not writing off anything for the purpose of income tax. So in the second year, actually you are writing off 50,000 more under Companies Act compared to income tax. Listen carefully friends. In first year, 1 lakh was written off more under income tax. In second year, 50,000 was written off more under Companies Act. In third year also, 50,000 was written off excess under Companies Act. If you see 1 lakh, 50,000, 50,000. Here if you see, if you net off all these numbers, what is the answer? 0, because 1 lakh excess was reversed in the second and third year. That is why we call depreciation as a time adjustment. So we spoke about time adjustment theoretically. Now we saw an example, an examination question where depreciation time adjustment we noticed here. Fantastic. Friends, we already learned that deferred tax is an accounting estimate. Remember one golden rule. An accounting estimate should be reassessed at the end of every accounting period. I mentioned this point to you already. An accounting estimate should be reassessed at the end of every accounting period. You know how you are supposed to do this calculation? Come to the end of first year. You have to make an accounting estimate for deferred tax. Come to the end of first year. Look at the timing difference. Cumulatively, focus on this word. Cumulatively, how much did you provide for as depreciation under Companies Act? Under Companies Act, at the end of first year, you provided for 50,000. Then cumulatively, how much of depreciation was provided under income tax? We provided 1,50,000. Okay. Now, there is a difference at a cumulative level you are checking. In the first year, it doesn't matter. Cumulative is just that period, but still, as a principle, we are checking the cumulative number. So, 1 lakh is the difference. What is the impact of this 1 lakh compared to what depreciation was deducted to arrive at PBT? Extra 1 lakh was deducted to arrive at taxable income. That is what has happened. Now, that 1 lakh when you deduct, that will reduce the taxable income. If it reduces the taxable income, naturally what will happen? In the first year, tax for the period also will come down, right? In the first year, let us look at what is the profit before depreciation and tax. In the first year, profit before depreciation and tax is 2 lakhs. Then, depreciation for tax purpose is how much? 1,50,000. So, taxable income is 50,000. On this 50,000, it is given to us that tax rate for the current period is 40% and apply that 40%. So, tax for the first year comes to 20,000, right? So, current tax, we are talking about current tax. Current tax is 20,000 in the first year. The same calculation we can also see like this. Profit before depreciation and tax is 2 lakhs. It means the depreciation as per Companies Act is not yet deducted from this. Imagine you deduct the depreciation as per Companies Act. For a moment, deduct the depreciation as per Companies Act. How much is that? 50,000, right? So, deduct that 50,000. So, you will get profit before tax as 1,50,000. Okay, right. So, PBT 1,50,000. Then, PBT 1,50,000. If you want to arrive at taxable income, what should you do? Add back depreciation as per Companies Act. How much is the depreciation as per Companies Act? 50,000. Add back. How much do you get now? 2 lakhs. Then, deduct depreciation as per income tax. What is the depreciation as per income tax? 1,50,000. How much did you get? 50,000. That is what is a taxable income. So, the same taxable income of 50,000, we arrived at it in a simpler manner because the question already gave us profit before depreciation and tax. Just be careful with that point. Wonderful. Now, in this, just compare what is profit before tax that we saw? 1,50,000. What is taxable income that we saw? 50,000. Is there a difference between the two? We are at the end of first year, right? So, is there a difference between the two? Yes. The difference between the two is an amount of 1 lakh. What is this 1 lakh? The difference between 1,50,000 of depreciation as per income tax and 50,000 of depreciation as per Companies Act. That same 1 lakh is what you see here, right? That 1 lakh of difference. Next question. You got the difference. What is the next question? Is this difference permanent or temporary or timing? It is temporary or timing difference because this will get neutralized or adjusted in the future accounting periods. So, this is timing difference. Fantastic. So, we got the difference, then we said this is timing difference. Next point. This timing difference into tax rate. Which tax rate should we consider? Enacted or substantively enacted tax rate. What is the tax rate given in the question? We don't have any different tax rate for current year and for future years. So, same 40% you will apply. Come on, apply 40% on 1 lakh. 1 lakh into 40%, 40,000. 40,000 is the deferred tax. Now comes the question, is it deferred tax asset or deferred tax liability? Think about it. What has happened here in the current year? Because extra amount of 1 lakh got reduced from PBT to arrive at taxable income, the taxable income came down. If taxable income comes down, tax for the period also comes down. Tax came down, but is it that permanently we will pay less tax? No. In the current year it came down, but in the future we have to pay even for this. So in the current year we are not paying, but in future we have to pay for something that happened in the current year. So we are liable. We are not paying now, we have to pay in the future, but it is relating to current year. So we are liable. If we are liable, it is a liability. Liability, what is the journal entry for that? Expense account debited to liability account. Recall, we spoke about this already. Rent expense to rent payable, the same way. Deferred tax expense to deferred tax liability. In the first year, for how much amount? 40,000 rupees. That's all. Right. Now, how do we present these in the financial statements? In P&L account, how will this get reflected? Look at this. Profit before depreciation and taxes. First year, what is the profit before depreciation and taxes? 200,000 or 2 lakhs, right? Then, less. What is the depreciation that will be reduced? Depreciation of 50,000 will be reduced. Then, profit before tax, 1,50,000. Then, now you have adjustment for taxation. You see, tax expense. Under tax expense, there are two items. What are the two items? Current tax and deferred tax. Current tax, clearly we have computed that at 20,000 rupees. Then deferred tax we computed as 40,000. So total tax expense is 40,000 of deferred tax plus current tax of 20,000, total is 60,000. So 60,000 you will reduce from 1,50,000. So what is profit after tax? 1,50,000 minus 60,000, 90,000 is the profit after tax. Now remember friends, from examination point of view, to be able to score all the marks that these questions give you, because almost in every exam you will find a question from deferred tax. It's a fairly important standard. So you have to make a separate working note for current tax. You have to have a separate working note for deferred tax computation and separate note for the presentation what you are doing for P&L. If the question in exam is asking you to present P&L account, then give in the working notes current tax and deferred tax. If the question in exam is asking you to make the computation for deferred tax as the main part, then you can give current tax in the working and deferred tax can be a part of the solution. So whatever is asked in the question as a main point, you show that as a solution. Rest of it, I suggest you give as a working note, and importantly give working note numbers. And if you give working note 1 reference for current tax, that reference you should give wherever you are using those numbers of current tax. Okay, remember these points. Now let's go to the second year. Important points to bear in mind when you move to the next year calculations. Friends, accounting estimate, don't forget these words. You have to consider on a cumulative basis. Now listen carefully to the methodology for second year. Come to second year. Let us look at the current tax working. First, for the second year, let's look at current tax working. What is the profit before depreciation and tax for second year? Again, you find that 2 lakhs is the profit before depreciation and tax for second year. Then less depreciation for second year as per taxation. Entire 1,50,000 got written off in the first year. So second year you don't have any depreciation. So 0. Then based on that, what is the profit on which you have to pay tax? We call it as taxable income. What is the taxable income of second year? 2 lakhs is the taxable income of second year. On 2 lakhs, what is the tax rate? Apply 40%. 40% on 2 lakhs. 80,000 is the tax in the second year. We call it as current tax of second year. Right. So current tax of second year we have done. Now let us come to deferred tax. Is there a timing difference? Right, let's go to that. Yes, there is timing difference. To arrive at timing difference, I would suggest take the cumulative depreciation as per Companies Act and cumulative depreciation as per income tax. In the first year, as per Companies Act, what was the depreciation? 50,000. Second year, 50,000. So what is the cumulative depreciation as per Companies Act? 1 lakh. Then come to income tax. First year depreciation 1,50,000, second year depreciation 0. So cumulative depreciation as per income tax is 1,50,000. What is the difference that you notice? Difference is 50,000. So extra 50,000 got reduced from the profits to arrive at taxable income. So this is the timing difference that we computed. So don't simply take 50,000 minus 0 and say this is only the timing difference. I would suggest this kind of a method is better for getting more accurate answers for the examination purpose or even for real life purpose, right? So here 50,000, that is cumulative 1 lakh minus cumulative of income tax 1,50,000. So the timing difference is 50,000. This 50,000 of timing difference into enacted or substantively enacted tax rate of year 2 means what? Not tax rate of year 2. In year 2, if this is year 2, if you stand, what is the future tax rate looking like? From year 2, you will see what is the future tax rate looking like. So future tax rate in this question only 40% is given. So apply 40%. So 50,000 into 40%. 20,000 should be the closing deferred tax. Asset or liability? Which one is more? Depreciation under income tax is more. Same logic. If depreciation under income tax is more, then profit on which you would have paid tax will be low. If that is low for now, you will pay it later. So you will be liable to pay that money later. So the liability is already created now and you will pay that money later. So it is a deferred tax liability. 50,000 into 40%, 20,000 is the deferred tax liability. Closing deferred tax liability. Now friends, let us look at the ledger account of deferred tax in the first year and second year and make some interesting inferences. First year deferred tax liability account, second year deferred tax liability account. Let us first deal with this. First year deferred tax liability account. There is a journal entry in the first year which we already discussed. Expense to liability, right? In a liability account, what do we write? By the deferred tax expense, right? So by deferred tax expense, how much was written in the first year? Recall, how much was written in the first year? 40,000 is what you have written in the first year, right? Then closing balance, to balance carried down, 40,000, closed, that's all. So deferred tax liability account is showing a closing balance of 40,000 at the end of first year. Clear? Right. Now come to second year. What is that you would obviously do? That closing balance of first year will become opening balance of second year. By balance brought down, 40,000. Alright. Now, straight go to the closing balance of second year. To balance carried down. This is not a balancing figure now. You computed it just now. By taking the timing difference cumulative at the end of second year and applying the tax rate, you found that closing cumulative deferred tax liability at the end of second year is 50,000 into 40%, which is 20,000. You computed that, right? Write this. To balance carried down, 20,000. Now, opening balance is 40, closing balance is 20. What would have happened to this 20,000? Now come to the balancing figure, which is the P&L impact of current year. Current year means what? Second year. So second year, what is the amount which is seen as balancing figure? 20,000. 40,000 of liability has become 20,000 of liability. Friends, think about it. You have to pay to somebody 40,000 rupees liability, right? So I'm just trying to give a simple example. You have to pay to somebody 40,000 rupees. That 40,000 rupees at the end of second year suddenly became 20,000 rupees. I am saying that, hey, you have to pay to that person only 20,000 rupees, not 40,000 rupees. Means 20,000 rupees, option 1, you should have paid, or maybe that person said, don't pay me, right? So basically, that liability should get reduced. If liability should get created, what was the entry we were passing? Expense to liability. If liability should get reduced, what entry should we pass? Opposite of that, right? If liability should get created, expense to liability. If liability should reverse, liability to expense. So similarly here you will say to deferred tax. Here it is a P&L impact of 20,000 rupees. Now interesting, what has happened in second year? 40,000 which got created in first year is reversed to the extent of 20,000 in the second year. That is exactly what has happened. Friends, in the second year, when this 20,000 is getting reduced, so just think about it. In the ledger account, in first year, 40,000 got credited to the ledger. But in second year, what happened? 20,000 got debited to this particular ledger, right? So basically reverse impact compared to what has happened in the last year. So is it that in second year deferred tax asset is getting created? Don't say that. In first year deferred tax liability got created. In second year don't say that deferred tax asset is getting created. Deferred tax liability which was created in the first year is getting reversed to the extent of 20,000. 40,000 of liability got created in the first year, that is getting reversed to the extent of 20,000. Reversal of deferred tax liability should not be written in the exam as creation of deferred tax asset. Even though if you see mathematically the treatment looks similar, but remember when you are writing the text in the examination, when you are explaining these points, don't call that as deferred tax asset creation, it is reversal of deferred tax liability. Right. So how does this look in the P&L of second year? For a moment, without going into the vertical form of P&L, if I just make a T-shaped P&L just for mathematical understanding, what is the profit before depreciation and tax? 2 lakhs, right? Then what is the depreciation for second year? 50,000 is the depreciation for second year as per accounting norms, right, or Companies Act as we call it. Then, so this has become 1,50,000. Then, what is the next thing? Tax. Current tax for second year is 80. Now, listen carefully. Mathematically, if I credit to P&L, an amount of 20, why are we crediting to P&L? It is reducing the liability. Liability is gone. If liability is gone, it's good for us, right? So we are crediting to P&L. If we credit to P&L an amount of 20, then what is the profit after tax? 90,000, right? That's all. So this amount which you mathematically credited to P&L, for presentation purpose, we don't do it as crediting to P&L. What do? We show it as a reduction under that tax category. Now, come to presentation, what you should follow for examination. Profit before depreciation and tax, how much? 2 lakhs less depreciation 50,000, then profit before tax 1,50,000 less tax expense. Under that, what are we writing? Current tax of 80,000, then deferred tax minus 20,000. So what will happen? 80,000 minus 20,000. So what is the net impact? Tax expense will be 60,000. So take it to outer column, and finally you will have profit after tax at 90,000. Fantastic. Now let's quickly look at third year. Logic is not going to change now, right? So current tax 2 lakhs of profit minus, what is the depreciation as per income tax? 0. Then on 2 lakhs apply 40%, 80,000 is the current tax. Done. Now come to deferred tax. Deferred tax, come back to the principle. Cumulative depreciation as per Companies Act 50, 50, 50, total 1,50,000. As per income tax 1,50,000 plus 0 plus 0, total 1,50,000. What is the difference between the two? Nothing. 1,50,000, 1,50,000 in both the cases. So timing difference is 0. So there is no question of timing or permanent. Let's come to illustration 2. In the illustration 1 that we just solved, if the substantively enacted tax rates for the 3 years were given as 40%, 35% and 38%, how will the deferred tax amount be? Now, Go back to the logic. In the first year, what is the timing difference? 1 lakh 50 minus 50. 1 lakh is the timing difference. 1 lakh into substantively enacted tax rate for first year. How much is that? 40%. Apply 1 lakh into 40%. 40,000 is the closing deferred tax liability for first year. And for the same thing, you have to create an expense also. So what is the journal entry for first year? Deferred tax, expense to deferred tax liability, 40,000, 40,000. Come on, present this into a ledger account and see how it looks. By deferred tax expense, 40,000. No other adjustment. To balance carried down, 40,000. That's all. Now, come to the second year. In the second year, what is the cumulative timing difference? As per Companies Act, 50,000 plus 50,000, 1 lakh. As per income tax, 1 lakh 50,000 plus 0. So, 1 lakh 50,000 total. So, the cumulative difference is 50,000. 50,000 into what tax rate will you apply? You will apply 50,000 into substantively enacted tax rate of year 2, which is 35%. 35% on 50,000 is 17,500. So, cumulative closing balance of deferred tax liability for second year is 17,500. Fantastic. Now, drop a ledger account for second year. Opening balance, which will come from closing balance of last year. By balance brought down, how much is that? 40,000. To balance carried down, just now you calculated, how much is that? 17,500. The difference between the two should go into P&L. Basically, it is getting reversed in this period. So, to deferred tax, basically this amount will go into P&L. This is reversal of deferred tax liability created in the first year. To what extent? Balancing figure, which is 22,500. So, year 2 is closed. So, in year 1, 40,000 was the debit to P&L. In year 2, 22,500 is mathematically credit to P&L, but we will call it as reversal. So, basically, it will not be debited to P&L, it will be reduced from whatever should be debited to P&L. So, we can say technically it is something like a credit to P&L. Okay, right. Then come to year 3. In year 3, what has happened? Closing difference is, we already saw just a little while ago, 50,000 plus 50,000 plus 50,000, 1 lakh 50,000. 1 lakh 50,000 plus 0 plus 0, 1 lakh 50,000. So, there is no difference between these two. So, the difference is 0 into what tax rate will you apply? After all, if this 0 is the difference, what tax rate should you apply? Substantively enacted tax rate of this year into 38%, which is 0. That's it. So, closing cumulative deferred tax liability should be 0. Come to year 3 ledger account. By balance brought down, 17,500. To balance carried down, 0. What has happened to 17,500? This will technically get credited to P&L. We know how to present that, but I am just saying it will mathematically, if you see it, it is like a credit to P&L. That's all. So, 17,500 will go and get credited to P&L. So, in our ledger account, it will be debited to deferred tax. It will be debited to P&L, it will be transferred to P&L. That's it. Let's look at illustration 3. Financial year is ending on 31st March. First year, there is a loss of 1 lakh. Year 2 and year 3 are profits of 50,000 and 60,000 respectively. Tax rate is 40%. As per income tax, loss can be carried forward up to 8 more years. There are a few assumptions given. At the end of first year, it was virtually certain, supported by convincing evidence, that the company would have sufficient taxable income in the future against which unabsorbed depreciation and carry forward losses can be adjusted. It is also assumed that there is no difference between taxable income and accounting income, except that set-off of loss is allowed in years 2 and 3 for tax purposes. Now, in this question, in the very first year, we see a loss of 1 lakh, right? Now, I can simply tell you 1 lakh is the loss, 40% is the tax rate, apply 40% on 1 lakh, 40,000 is a deferred tax asset. But there will be one question in your head, but why is 1 lakh the timing difference? How can we say that 1 lakh is the timing difference? This kind of questions come to us because till now what have we been doing? We have been identifying first difference, then deciding whether it is timing difference or permanent difference. Then on the timing difference portion we have been applying the tax rate, right? What tax rate? Enacted or substantively enacted tax rate. So here we need to do a little more work to get confident that acha, correct, so whatever we are doing is right and this 1 lakh of loss is a timing difference. Let's take an example. Say if the company has a loss of 1 lakh, let us compare what would happen as per accounting norms and what would happen as per income tax norms. Okay, right. Let's say this is accounting and this is income tax. First, if it is profit, we will see what will happen, then we will just change it to loss and then we will talk about what will happen. If it is profit, profit of 1 lakh, okay, right, tax is 40%, 1 lakh into 40%, 40,000 is the tax. Here also say it is 1 lakh into 40%, 40,000 is the tax, okay. All other adjustments are same and this is comparable and 1 lakh into 40%, 40,000 is the tax what we would have had to pay, okay, fantastic. Now imagine this is accounting, this is tax, right? If this is not plus 1 lakh, if this becomes minus 1 lakh, okay, if this becomes minus 1 lakh, obviously here as we discussed it will become 40,000 of tax, not something that we should pay. This becomes 40,000 of tax which we should receive. But will government pay us? No, they will not. When you come to tax calculations, what will happen? Minus 1 lakh, actually it should have been 40,000 that government should have paid. Government will tell nothing doing, we will not pay you anything now, so we will treat your profit to be 0, not minus 1 lakh, we will treat your profit to be 0, thereby the tax what you have to pay will also become 0. Actually the company says, hey, our profit is not 0, actually we have a loss of minus 1 lakh. The income tax says, sorry, this you adjust in the future, this you adjust in the future. So what will happen now? Because of this tax adjustment, even though our loss is 1 lakh, that loss is not getting registered for current year taxation, it will be carried forward and set off against future profits. So in the current year if you see, the tax what you have to pay is 0, it means back working, your taxable income is also 0, whereas actually your accounting income or loss is minus 1 lakh. Is there a difference of 1 lakh that you see here? Yes, that 1 lakh of difference is what we are calling as timing difference. This is called as timing difference because in the future years it is going to be adjusted. Now, if we have to present this into P&L, let us see how that would look like. In the first year, what is the profit? Well, it is not profit, it is loss. So, minus 1 lakh. Then, below that, what is the current tax? 0, there is no current tax. Then, 0, what about deferred tax? Is it deferred tax liability or a deferred tax asset which got created? We created a deferred tax asset, right? Why asset? Because in future we will get benefit on account of this. So it is a deferred tax asset. So deferred tax asset is 40. So plus 40. So as a result what will happen? 100 loss and this is plus 40. Something like to P&L there is a loss of 100. There is a gain or something which is credited to to P&L to the extent of 40. What will the net impact be? Net impact will be 60,000 negative, right? So minus 60,000. Minus 60,000 is the loss after tax adjustment. Even though we did not pay any current tax, there is a deferred tax asset that we recognized to the extent of 40, as a result of which loss of 1 lakh, which was before tax, became loss of 60,000 after tax. Now let's move to the second year. In second year, there is a profit of 50,000. Let's talk about current tax calculation of second year. Profit of 50,000. Should we pay tax right away? No. Profit of 50,000, but there is a loss of 1 lakh from first year which is being carried forward. So that 50,000 of profit minus 50,000, we will have to pay tax on profit which is 0. So gone, that's done. What is the amount which is still left out in the loss carried forward? 1 lakh loss. In that 50,000 we adjusted. So how much is the loss which is still not adjusted against profit? 50,000, right? That 50,000 of loss is the cumulative closing balance on which we have to create a deferred tax asset. That is going to be the cumulative closing balance of deferred tax asset at the end of second year. So how much will that be? 50,000 of loss into 40%. So 20,000 will be the deferred tax asset at the end of second year. Now let's look at the ledger accounts for deferred tax asset. Deferred tax asset. First year what would have happened? To balance brought down. In first year 0. Then to deferred tax. How much is the deferred tax which got created in first year? 40,000, right? So 0 opening balance, 40,000 got debited, and closing balance by balance carried down 40,000, right? Come to second year. In second year, what is the opening balance? To balance brought down 40,000. Then what is the closing balance of second year just now that we calculated? By balance carried down 20,000. Means what has happened in the second year? By deferred tax, the transfer to P&L is to the extent of 20,000. This 20,000 is the debit to P&L, right? It is credited to deferred tax asset account. The debit impact will hit P&L. That's all. So two side effect, right? So credit is here and debit impact will go to P&L. So 20,000 will be the charge to P&L in the second year. That's all. Now let's look at how the presentation for year 2 will be done. Profit for second year. Profit for second year is how much? 50,000. Then tax. What tax are we talking about? Current tax is 0. Deferred tax on account of reversal of deferred tax asset is how much? 20,000. So minus 20,000. So what will be the profit after tax? 30,000. Friends, remember this golden rule. Deferred tax liability, if it increases, it will be debited to P&L. Deferred tax liability, if it decreases, the impact will be credit to P&L. Deferred tax asset, if it increases, the impact will be credit to P&L. Deferred tax asset, if it decreases, the impact will be debit to P&L. Now come to the third year. In the third year, what is the profit? Profit is 60,000. Now let's go to current tax calculation of third year. 60,000 is the profit, but what is the carry forward of loss of first year which was not adjusted even at the end of second year? 1 lakh minus 50,000 adjusted in second year. So still there is 50,000, right? So 60,000 minus 50,000. So 10,000 is the profit of year 3 after adjusting this carry forward loss. Then on 10,000 apply 40%. So 40% on 10,000, 4,000 is the current tax that has to be paid in year 3. Fantastic. Now what is the deferred tax asset opening balance at the end of year 3? This will be closing balance of year 2. What is the closing balance of year 2? 20,000. So this will be the opening balance for year 3. Now, at the end of year 3, is the entire amount of 1 lakh written off? Yes, 15 year 2, 15 year 3. So totally entire 1 lakh is written off. So what is the balance timing difference? 0. 0 into the tax rate. So 0. So closing deferred tax asset should be 0. To balance brought down 20, by balance carried down 0. So what is the amount which should be transferred to P&L? 20,000 should be transferred to P&L. Credited to this account, debited to P&L account. So 20,000 will be debited to P&L account. Now, if I look at P&L, presentation and disclosure, how will it look? The profit for the current period, 60,000, current tax 4, deferred tax adjustment to this extent of 20,000. So total is 24,000 of taxation, 60,000 minus 24,000, 36,000 will be the closing profit after tax. Let's make an interesting analysis here. In the first year, profit is minus 1 lakh. So we actually calling it loss, right? So profit is minus 1 lakh. On that, look at 40%. What is 40% of that? 40,000. 40,000 is the deferred tax asset which got created in the first year. So look at the total of taxation in the first year is 40,000, right? Then come to second year. In second year, what is the profit? 50,000. On that profit, apply 40%. What is the tax? That comes to 20,000. Is the current tax plus deferred tax totally 20,000? Yes. Current tax 0, deferred tax 20,000. Total tax impact is 20,000. So again at 40%. Come to third year. In third year it is 60,000. On 60,000 if you apply 40%, what is how much does that come to? 24,000. How did you get 24,000? 4,000 of current tax plus 20,000 of deferred tax adjustment. So effectively what has happened? Matching concept got ensured. Same 40% is the effective tax rate what you see in all the years, even though there was a loss in the first year. Friends, but just remember, this 40% uniformly is happening because the difference is only on account of timing difference. If there is any permanent difference, then this can change. Now let's look at a few other important points which are covered by accounting standard interpretations. Friends, remember, when we are learning something, whatever is there in accounting standard interpretations, any points from guidance notes, everything we should cover, because in examination, whatever question is asked, you should have the confidence to answer, right? Okay, now, accounting standard interpretation 4 talks about how deferred tax asset can be created in case of losses on capital assets. Let's talk about that now. Carry forward and set off of losses under the head capital gains. Losses under the head capital gains can be set off only against future gains under that head. Who tells this? Income Tax Act has these points. So that is why only when there is reasonable or virtual certainty that there will be future capital gains under that head, you can recognize deferred tax asset on such losses. Otherwise, ignore creation of any deferred tax asset on such items. Now, let's talk about another accounting standard interpretation 7 on presentation and disclosure of these deferred taxes. Deferred tax asset should be shown below non-current investments. Basically, it is a non-current item, it is not a current item. Next, deferred tax liabilities should be shown below long-term borrowings. So, remember, both are non-current in nature. As long as you are classifying them under non-current, it should be sufficient. Accounting standard interpretation 9. This talks about the meaning of virtual certainty. Friends, this interpretation clarifies that This word virtual certainty is not just management representation, is not just some internal evidence. It is basically convincing evidence with some proof. There should be something to back this up, saying there will be future profits that the company will have, against which these losses can be set off. Like that, there should be convincing evidence. That convincing evidence is what is emphasized. So it is not mere forecasts or projections given by management. So particularly when you are doing audits, it is important to check this. When the companies have any losses and if they are creating deferred tax assets, be sure that there must be concrete evidence that sure, there is a contract, this contract will give this much of profit and these will be the expenses, in the future there will be taxable incomes. Like that, you have to see with a strong evidence, only then you should accept. So just more like a thumb rule, let me give you something like this. You should have at least 90-95% confidence that yes, there will be profit in the future. So that is what you mean by virtual certainty. Friends, let's now look at Accounting Standard Interpretation 3 and 5. So both these deal with situations where there are tax holidays, or we call them tax breaks. So what is this concept of tax holiday or tax break? Say you are doing business in an industry where government believes that encouraging that industry is required. For example, power generation. Government believed that encouraging power generation is required, and under 80 IA, special benefits have been rolled out to power generating companies. Now, for such companies, what government has done is it gave an option that in the first 15 years, they can choose any 10 years, and in those 10 years, whatever technically taxable income they get, that entire income was allowed as deduction. Means what? If your taxable income is 100, your deduction is also 100. So effectively, whatever taxable income you get from that business is not taxable for that particular period. So that concept is what we call as tax holiday. So if it is for the 5 years, 10 years, whatever be the period, so that period is what we call as tax holiday. The discussion is, if a company has tax holiday, will deferred tax calculation be affected because of that, or how should we do the deferred tax calculation for such companies? Now, this concept let us relate to illustration 1 what we learnt. Recall, in illustration 1, in year 1, 2 and 3, we had for Companies Act or accounting standard purpose 50,000, 50,000, 50,000 as depreciation, and for the purpose of income tax, entire 1,50,000 was written off in the very first year, right? So that's what we have seen. Imagine we are at the end of first year. Question 1, is there a difference? Yes. Is that difference timing difference? Yes. Okay, right. So what is the timing difference that we see for the first year? 1 lakh is the timing difference that we see for the first year, right? Next aspect. When will this reverse? This is reversing in year 2 and year 3. We have already seen that. If it is reversing in year 2 and year 3, imagine if the tax holiday is for 3 years. If tax holiday is for the first 3 years, then the entire reversal is within the tax holiday period. I am repeating, if the amount whatever is getting reversed, 1 lakh is getting reversed in the second and third year, if the tax holiday is for the first 3 years, then it means that entire amount is getting reversed within the tax holiday period. The amount which gets reversed within tax holiday period will be treated as permanent adjustment or permanent difference. So we do not calculate deferred tax on such amount. I repeat, check whether there is any difference. Second, see whether the difference is timing difference. Third, check the portion of timing difference which is getting reversed within tax holiday period. If it is getting reversed within tax holiday period, that difference will be called as permanent difference, even though technically we would have considered it as timing difference. Because it is getting reversed within tax holiday period, we will consider it as permanent difference. Only the timing difference which is getting reversed beyond tax holiday period will be called as timing difference, on which deferred tax calculation will be required. So imagine if the tax holiday is not for 3 years, tax holiday is only for 2 years, say. Okay, so had tax holiday only been for 2 years, year 1 and year 2, now 1 lakh of difference got created in first year, 50,000 got reversed in the second year, balance 50,000 got reversed in the third year. Now, if tax holiday is only for 2 years, then you can clearly say, hey, even though 50,000 got reversed in second year, there is some portion which is getting reversed beyond tax holiday period. Then, on that 50,000 which is getting reversed in year 3, we will start talking about deferred tax calculation. So, when will you create the deferred tax? On the timing difference which is reversing beyond tax holiday period. In our example, whatever is getting reversed in year 3, you will create deferred tax liability in year 1. So, you will calculate 1 lakh is the timing difference. On 1 lakh of timing difference, again split that. The portion which is getting reversed within tax holiday period 50,000, it becomes permanent difference, and the balance which is getting reversed beyond tax holiday period 50,000. 50,000 into enacted or substantively enacted tax rate. That will be the deferred tax liability which should be recorded in year 1. Now get this point right. While we consider the timing differences which reverse beyond tax holiday period for deferred tax calculation, deferred tax creation is happening in the tax holiday period only. As you see, in year 1, technically year 1 and 2 are in tax holiday period. So in year 1 only we are doing the deferred tax calculation and we are recording that. Now the question is, why do we say that the differences which reverse within tax holiday period are permanent differences? Why do we say that? Friends, this is accounting, this is taxation. There is an item called depreciation which you recorded here at 50,000 and here you recorded at 1,50,000. Now, why are we saying that the portion which reverses within the tax holiday period is a permanent difference? Now, think about it carefully. In the tax holiday period, here in accounting, even if you have something like profit, even if you have something like income, in taxation, it is all considered as if these numbers are all zero, meaning there is no tax that has to be paid. See, on taxable income, normally we pay tax, but here it is all treated as zero. Why? There is a tax holiday period that is being enjoyed. So here there is a number. Here, even though there were numbers, they are all treated as zero practically for the purpose of taxation. Now, in a case like that, there is a difference which is getting created. Is this difference something which has to be adjusted, or is it something reversible in the future? No, this is permanently a benefit what the company gets. Because of that, we call it as a permanent adjustment. Let's look at this problem. Goodwill Limited is a full tax-free enterprise for the first 12 years of its existence and is in third year of operation. Depreciation timing difference resulting in a deferred tax liability in first, second and third year is 200 lakhs, 300 lakhs and 400 lakhs respectively. So 200, 300, 400 got created as deferred tax liability in each of these years. Okay, right. Then from the fourth year onwards, it is expected that the timing difference would reverse each year by rupees 10 lakhs. Assuming tax rate at 35%, find out deferred tax liability at the end of third year and any charge to P&L. So this was an examination question. Let's draw a timeline. in year 1, 2 and 3, there were timing differences, 200, 300 and 400 respectively. Now, cumulatively, at the end of year 3, as we stand, at the end of year 3, the total timing difference is 900 lakhs, right? Next, tax holiday is till year 12. So, from year 3, there are 9 more years that we have to consider for tax holiday. Okay. In the first 3 years, timing differences of 900 could have resulted in deferred tax liability, but they are getting reversed starting from year 4. Each year, year 4, 5, 6, so on till year 12, 9 years. Each year, how much is getting reversed? Each year, 10 lakhs of timing difference is getting reversed. Excellent. If 10 lakhs of timing difference is getting reversed each year for 9 years, cumulatively in 9 years, how much of timing difference would have reversed? 10 lakhs into 9 years, which is 90 lakhs. 90 lakhs of timing difference would have reversed, right, within the tax holiday period. In a case like that, the accounting standard says 900 lakhs is the total timing difference. Split that. What is the timing difference reversing within tax holiday period? 90 lakhs. Okay. Don't consider any deferred tax on that because it will now be treated as permanent difference. Then, what is the balance left out? 900 minus 90, 810. 810 lakhs is the timing difference reversing beyond tax holiday period. We can create deferred tax liability only on that portion. So, the timing difference reversing beyond tax holiday period. So, now you see how it works. 810 lakhs into, what is the tax rate? 35%, that's given in the question. What tax rate should we consider? Enacted or substantively enacted tax rate. So, if you apply 35% on 810 lakhs, it comes to 283.5 lakhs. So, at the end of year 3, the cumulative closing deferred tax liability should be 283.5 lakhs. But will entire 283.5 lakhs be debited to P&L account of year 3? Definitely not. In year 1, some amount would have already been charged to P&L. In year 2 also some amount would have been charged to P&L as deferred tax liability. The balance will be charged in year 3. Now, to understand how this logic works, imagine if we were at the end of first year. What is the timing difference which got created in the first year? 200 is the timing difference which got created, right? Now, when will this 200 of timing difference get reversed? Well, starting from 4th year till year 12, there is an amount of 10, 10, 10 every year which is getting reversed. So, totally 90 lakhs will get reversed within the tax holiday period. So, out of 200, 90 would have been reversed within tax holiday. So, deferred tax should be created only on the balance of timing difference. So, what will happen? 200 minus 90, that is 110. On that, if you apply 35%, that comes to 38.5 lakhs. Deferred tax liability will be created in the first year to the extent of 38.5 lakhs. Come on, quickly draw ledger account and check. Is there any opening balance in the first year? No. Then, what is the entry for 38.5 lakhs of timing difference based deferred tax liability which we are creating? There is expense account which will be debited to deferred tax liability account. So, in deferred tax liability account you will write by deferred tax expense, right? So, that will be to the extent of 38.5 lakhs. Now, to balance carried on at the end of the year, 38.5 lakhs. Closed. First year accounting done. Now, come to the second year. By balance brought down, 38.5 lakhs. Then, come to the end of second year. at the end of second year, what is the cumulative timing difference? The cumulative timing difference will be 200 plus 300. 500 is the cumulative timing difference. But what is the portion of timing difference which will reverse within tax holiday? 500 minus 90. After all, that is getting reversed from year 4 onwards, right? So 500 minus 90. So the portion which will reverse within tax holiday period should be considered as permanent adjustment or permanent difference, and only the portion which is reversing beyond tax holiday period should be used to create deferred tax liability. So out of 500 subtract 90, that will be 410. 410 into 35%, that will be 143.5 lakhs. 143.5 lakhs should be the closing cumulative deferred tax liability at the end of second year, meaning to balance carried down 143.5 lakhs. Now, in the second year, opening balance is 38.5, closing balance is 143.5. What is the difference? 105 lakhs. So, 105 lakhs should be created in the second year as deferred tax liability, which should be charged to P&L. So, what will you do? Buy deferred tax expense to the extent of 105 lakhs. That's all. This 105 lakhs in turn will go into P&L account. So, remember, in the first year 38.5 went to P&L, in the second year 105 lakhs went to P&L. Now, come to the third year. As you come to the third year, there is already, just repeat the same logic, there is already an opening balance of closing cumulative deferred tax liability. How much is that? 143.5 lakhs. Okay. Then come to the end of third year. Just now we did that calculation. 200 plus 300 plus 400, totally 900 lakhs minus timing difference which is reversing within the tax holiday period, which is 90 lakhs. So totally it will come to 810 lakhs into the deferred tax. You have to calculate, right? So you have to multiply that with the rate. So when you multiply that with the rate of 35%, you have 283.5 lakhs. Now, what is the opening balance? 143.5 is the opening balance and closing balance is 283.5 in the third year. Based on this, what is the charge to the P&L account of third year? Balancing figure. 140 lakhs will be the charge to P&L account of third year. The next accounting standard interpretation is ASI 6, which is to do with MAT, minimum alternate tax. Let's understand some basic points regarding MAT, which you will learn in detail as a part of your taxation paper. Friends, say there is a company, it is enjoying tax holiday. Now, what will happen? It might have accounting income, but it is not paying taxation, right? So, it is not paying tax because there is a special benefit available under Income Tax Act. What income tax has intelligently done is, it came up with a concept called MAT, saying you are making profit, you are not paying tax, we want tax, but government has given something like a tax holiday, we will find a way to work around it. Pay tax in this year, but it is not tax for this year. Listen carefully. Pay tax in this year. But you will say, hey, why should I pay tax in this year? We have a tax holiday. Fine. It is not for this year. We know you have a tax holiday. Pay tax in this year. Now, you will be like, okay, I'll pay tax now. So what will happen? You will pay tax calling it as MAT. That can be carried forward, and in the future when you have to pay tax, you can just say, I already paid MAT, it is paid something like paid in advance, and now I will not pay to that extent what I have already paid in the past. So like this you can take a set off or a benefit in the future. So I just oversimplified the concept of MAT for you, but basically it is something like this. You are paying in this period even though you have a tax holiday, but you are not paying for this period. This money, what you are paying now, can be taken as a set off in the future. Something like it's a prepaid tax. You can again consider this MAT also as a prepaid tax. Now, the question is, the MAT what you pay, if you call it as a prepaid tax, it is an asset, right? So, it will be considered as an asset. If it is considered as an asset, can we call it as a deferred tax asset is the question. The interpretation says it is an asset but not a deferred tax asset, because when will it be considered as an asset? If it has the capability to generate future economic benefits, we can call it as an asset. Sure, as long as the entity believes that there will be future incomes against which this MAT what we paid can be set off, you can call it as an asset. But it cannot be called as a deferred tax asset because it is not getting created due to any timing differences, right? So it is not getting created due to timing differences where accounting income is something, taxable income is something else. There is a difference between the two. Because of that, you are analyzing and saying deferred tax asset. No, there is nothing like that with respect to MAT. So that is why accounting standard interpretation clarifies that MAT can be an asset, but it is not a deferred tax asset. Friends, this MAT concept is not only for the tax holiday period, it is for all companies. You know what we are supposed to do? Every year you will do the calculation of income tax as per regular income tax norms, and you will also compute MAT as per a special section called 115 JB. Every year you will check these and say this is the tax payable under this is 35, tax payable under this is 20, then you will see which is higher, this is higher, okay, pay this, right? So under income tax regular provisions is 35, under MAT 115 JB is 20, pay the higher of the two, pay 35. On the other hand, imagine as per regular provisions of income tax what you have to pay is only 10, but as per MAT provisions what you have to pay comes to 20, then what should you pay? You should pay 20, higher of the two. When you pay 20, the difference between tax as per these MAT calculations as per 115 JB and the one as per regular income tax, this difference, this extra what you pay under MAT will be treated as an asset, provided there is a reason to believe that there will be future taxable incomes against which this money what you paid extra can be set off. To understand this, let us take a small example as to how MAT gets created, how the difference gets adjusted and all of that. Let's look at this example. Consider 4 years. Year 1, 2, 3, 4. Normal tax liability we will calculate. Tax liability, when I say normal tax liability, I am talking about tax liability by applying the regular provisions of income tax. Tax liability under 115 JB, we also call this as MAT calculation, right? So tax liability under 115 JB. What is the amount that we have to pay? Higher of the two. Tax payable will be higher of normal tax liability or the tax payable under 115 JB, that is MAT provision. Okay. Now, consider first year. Normal tax liability 100, MAT based calculation 190. How much should we pay? Higher of the two. So we have to pay 190. But extra how much did you pay because of this MAT? You paid extra 90. 100 you should have paid as per the regular provisions also. 190 as per MAT norms. So extra how much did you pay? 90 you paid as extra. That extra what you pay, we will call that as MAT credit entitlement. This MAT credit entitlement is like an asset and that you will calculate. Okay, so in the first year, how much will be the MAT credit? 90. Then, will you use any MAT credit? No. Extra credit is getting created now. It is not getting used right now. Okay, right, nothing. So, totally 90 of MAT credit will be carried forward into the next year. So, it is an asset which will get carried forward into next year. Right. Now, come to second year. normal tax liability 170. Tax liability under MAT 115 JB 200. Again, how much should you pay? Higher of the two, so you will pay 200. So when you pay 200, still you paid an extra of 30. That 30 will be the additional MAT credit entitlement what you will have because of what you paid in the second year. So at the end of second year, you will have 90 plus 30, total 120 as the MAT credit entitlement, cumulative balance, right. Come to third year, situation is changing. In the third year, normal tax liability is 200, MAT 150, you will have to pay 200. Now listen carefully friends, you cannot say we have a MAT credit of 120 and what we have to pay now is 200, so we will set off entire 120 and we will pay only 80. No, that's not what you can do. What should you do? What is the difference between normal tax liability and 115 JB? 200 minus 150, that is 50. You can utilize the credit only to the extent of 50 in this year. You have 120 of credit, but out of 120 of credit you can utilize only 50 of credit in this particular year, and you will carry forward a credit of 70 to the next year. Come to last year, 260 is the normal tax liability, 170 is the tax liability under 115 JB. How much should you pay? 260. When you should pay 260, check the difference. 260 minus 170. How much of MAT credit can you actually utilize considering this 260 minus 170? Up to 90 you can utilize. Okay, but how much do you have? You have only 70. So that entire 70 can be utilized. Imagine if the amount of carry forward MAT credit was 100, then how much you would have utilized? You would have utilized only 90, not that entire 100. So here we just have 70, so that entire 70 can be utilized as MAT credit and only the balance will actually be paid. That's it.